Modern societies have been accustomed to economic growth due to the advancement of new technologies and an expanding workforce. However, over long periods, there are phases of economic growth. It is not uncommon for a country to face an extended period of slow growth. An economic deceleration will have implications for many aspects of society. Indeed, this may create instability in the economy, in fact, impacting the work of the central bank. In this segment, we ask, how do central banks deal with a persistent economic slowdown? Due to a persistent decline in economic growth, Japan has faced deflationary conditions for a persistent period. The central bank has responded by cutting policy interest rates. However, various factors keep the central bank from pushing interest rates much below zero. With the traditional monetary policy operating target pushed to the zero lower bound, the central bank has chosen unconventional monetary policy tools. After viewing this segment, you should be able to 1. Calculate the benchmark interest rate with the Taylor rule. 2. Identify unconventional policies. In the 21st century, advanced economies around the world have experienced a downturn in economic growth prospects. There are a number of possible explanations. Some people attribute this to demographics, which are reducing the available workforce. Others point to a slowdown in technological advance. Regardless, no country has experienced this growth deficit more severely than Japan, which has been experiencing slow growth since the turn of the millennium. This chart shows that other G7 countries have experienced a similar slowdown in more recent periods. The low economic growth potential in Japan has led to a decline in corporate investment. The decline in demand relative to potential is reflected in Japan's persistently negative output gap. Low demand has translated into low inflation. Since the early 90s, inflation has been low and usually negative, meaning consumer prices are largely falling. We know that the Bank of Japan has a mandate to achieve inflation of 2%, but currently inflation is far below that 2% level. What interest rate should the Bank of Japan set in order to achieve the inflation target? To answer this question, the economist Knut Wicksell introduced the concept of the natural interest rate, the hypothetical interest rate that would bring inflation to the stable target. Historically, the operational target is the overnight uncollateralized call money rate, which is the name in Japan for the interbank lending rate. Given the underperformance of inflation, the central bank should be cutting interest rates. Indeed, the Bank of Japan sharply cut interest rates in the 1990s, since when it has been flat near zero. However, even these low rates have not been sufficient to bring inflation to target. More recently, the economist John Taylor has proposed an estimate of the natural rate, which is based on the average of the output gap and the inflation gap. The inflation gap is the gap between inflation and the inflation target. Remember, the output gap is a percentage deviation of GDP from potential GDP. Taylor's proposed estimate of the natural interest rate can be constructed with a formula called the Taylor rule. Start with the long-term real interest rate, which we call R star. Add the current inflation rate as a baseline interest rate. Add to this the average of the output gap and the inflation gap. When the output gap is positive or inflation is above target, we should raise interest rates above baseline to slow down demand and inflation. When the output gap is negative and/or inflation is below target, we will need to cut interest rates below baseline to stimulate demand. In order to construct Taylor's estimate of the natural interest rate, we must first estimate the long-term real interest rate. An important complication is that the slowdown of economic growth has created a fundamental change in global bond markets. The global growth slowdown has pushed down the long-run interest rate. The reason is that a decline in corporate investment has changed the terms of borrowing, and now lenders can expect lower interest rates on their loans. There are complicated models to estimate R star, but a simple proxy is the long-term growth rate, which can be measured as the growth rate of potential output. In Japan, this has been at very low levels since 1990. Potential growth in the 1980s was robustly above 3.5%, but since then has been usually below 1%. There are a number of factors that led to this slowdown, but an important one was demographic. The growth in the size of the labor force has been slow and even falling in recent years. We can use data from Japan, along with the Taylor rule, to estimate a target for the natural interest rate. From the second quarter of 2016, the Bank of Japan reports a growth rate of potential output of 0.74%, which we use as a proxy for R star. Inflation of negative 0.33% combined with an inflation target of 2% implies an inflation gap of negative 2.33%, while the output gap is negative 0.35%. We use the Taylor rule to estimate the natural interest rate as negative 0.93%. So according to the Taylor rule, we need to set the interest rate at negative 0.93% to stimulate demand sufficiently to bring inflation to the target level of 2%. Use the Taylor rule and Japanese data to estimate the natural interest rate in Japan in recent years. The Taylor rule suggests that the interest rate necessary to generate enough demand to hit the inflation target is often negative. What does a negative interest rate mean? It means that if you borrow money, the lender actually has to pay the borrower extra money to agree to borrow. Can interest rates even go into negative territory? Remember, paper money pays a zero interest rate. Would anyone be willing to lend money at a negative interest rate when they could just hold on to cash and avoid making an extra payment to borrowers? Return to the liquidity preference model, in which the interbank rate is set by the supply and demand of liquidity. The Bank of Japan has offered an interest rate of 0.1% on deposits since 2008. The central bank can rapidly bring down the interest rate through open market operations. If the central bank increases the supply of liquidity sufficiently, the interest rate in the interbank market may fall to the deposit facility rate of 0.1%, and commercial banks have tended to hold their funds on reserve at a very small interest rate, rather than lend it out to other banks at lower rates. However, in 2016, that interest on the deposit facility was adjusted from positive to negative. At negative interest rates in the deposit facility, banks might be willing to lend money to each other at negative rates rather than pay the central bank to keep their funds on reserve with the central bank. Taking a closer look, the central bank sets a policy rate to target the interest rate on interbank lending. In Japan, the policy rate is the interest rate on the deposit facility called the complementary deposit facility interest rate. This remained at 10 basis points for the first half of the decade. The overnight interest rate tracked this facility rate. In 2016, the central bank adjusted the deposit facility rate to negative territory. This means that any commercial bank holding excess reserves at the central bank must actually pay a fee to the central bank. Rather than pay this fee, banks have been willing to lend money in the interbank market at negative interest rates. When the call rate is negative, that means that a bank needs to pay to lend. Commercial banks could, in theory, hold their reserves in the form of currency rather than keeping deposits at the central bank. This would allow them to avoid the interest costs when the policy rate is negative. However, in practice, the cost of assembling and storing hundreds of trillions of yen would make this difficult. The Bank of Japan describes its current monetary policy as quantitative and qualitative monetary easing with yield curve control. This has three parts. 1. Yield curve control. 2. Inflation overshooting. And 3. Unconventional asset purchases. Number 1. Yield curve control. The yield curve is the interest rate at different maturities. The central bank sets the short-term interest rate as negative using the policy rate. Rather than target long-term bond rates through the expectations channel, the Bank of Japan directly targets the interest rate on 10-year bonds. Currently, the central bank tries to set the interest rate on 10-year bonds near zero. In order to bring down long-term interest rates, the Bank of Japan engages in open market operations. Over the past decade, the Bank of Japan has engaged in persistent outright purchases of Japanese government bonds, or JGBs. The holdings increased eightfold, from 50 trillion to almost 400 trillion. This latter number is almost equal to the size of annual Japanese GDP. 2. Inflation overshooting. The central bank describes the inflation overshooting commitment as a commitment under which it continues expanding the monetary base until the year-on-year rate of increase in the observed CPI, all items less fresh food, exceeds the price stability target of 2% and stays above the target in a stable manner. The central bank promises to keep inflation high in the future. This is done to reduce the real interest rate today. The real ex-ante cost of borrowing will be reduced if inflation expectations rise. The central bank promises future inflation overshooting to push down the real interest rate today and encourage borrowing. 3. Unconventional asset purchases. The Bank of Japan also operates directly on the asset price channel. In spirit, the central bank tries to support stock prices by purchasing shares through unconventional open market purchases of exchange-traded funds. The Bank of Japan unconventional policy followed a sequence. In 2009, they faced the economic downturn associated with the global financial crisis with the conventional move of cutting policy interest rates, but ultimately cut interest rates near zero. In 2013, they implemented quantitative easing, which is the extensive purchase of JGBs. Qualitative easing are purchases of unconventional assets like exchange-traded funds to support the asset price channel was implemented in 2014. In 2016, the Bank of Japan formalized yield curve control, setting a negative policy rate and a target for the long-term government rate. At the same time, policymakers committed to inflation overshooting. So far, with the exception of a brief period in which a new sales tax was imposed, inflation has fallen short of the target. Though, in early 2018, inflation appears to be accelerating due to demand expansion. We will have to wait and see whether the Bank of Japan's unconventional policy operations will succeed. After viewing this segment, you should be able to 1. Calculate the benchmark interest rate with the Taylor rule. 2. Identify unconventional policies. A persistent deflationary trend in Japan has pushed policy interest rates to zero and then below. Having reached a limit in terms of the likely interest rate, the central bank has adopted a number of unconventional policy methods. They have engaged in a large-scale purchase of government securities to expand the liquidity available to the banking system. They've targeted long-term rates, adopted a zero interest rate. Most interestingly, they have committed to expansionary policy for as long as it takes to accelerate inflation past the 2% inflation target for an extended period of time. All of these policies are stimulating demand in the economy. We shall have to wait to see if they can bring inflation back to target.